Hi, my name is Aimaisara binti Umar Ali. My student ID number is 2021214998.
Hi, Assalamualaikum. My name is Farisha Faharna binti Wahizat. My matric number is 2021815438.
Hello, my name is Izdiha Ramya binti Muhammad Zahir and my student ID is 2021201892.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nur Ali Amira binti Muhammad Afandi.
Hi, my name is Nurul Balkis binti Ramli. My matrix number is 2021452774.
Hello, my name is Damia and I will present about the Malaysia Government Securities Market Players. Malaysia Government Securities are marketable debt instruments issued by the Malaysian government to obtain funds from the domestic capital market. The Central Bank, Bank Negara Malaysia, acts as a banker and advisor to the government and assists in planning and facilitating issuance through the market infrastructure it owns and operates. Currently, various forms of government securities in Malaysia, such as Malaysia Government Securities (MGS). Malaysia Government Securities are long-term interest-bearing debt securities issued by the Malaysia government to raise funds from the domestic capital market for development expenditure. The second is the Malaysian Government Investment Issue, MGII. MGII is a long-term Islamic government security issued based on established Sharia principles. The development of the Malaysia Government Investment Issue MGII market aims to deepen the domestic circuit market as well as strengthen Malaysia's position as a leader in global Islamic finance. Short-term discount securities, known as Malaysia Treasury Bill (MTB), have also been issued by the Malaysian government for operating capital, while short-term Islamic government securities issued in Malaysia based on recognized Sharia principle are known as Malaysian Islamic Treasury Bills (MITB). Another market player in the Malaysia Government Securities (MGS) is the non-resident investor. Non-resident investors in the Malaysian bond market comprise a diverse group of institutional investors, including foreign central banks and governments, asset managers, pension funds, and insurance companies. These investors contribute to market efficiency by providing valuable liquidity to the secondary market. By supplying essential liquidity to the secondary market, these investors help ensure market efficiency. Finally, Malaysia bonds have been included in several global bond indices due to their investment grade credit rating, progressive and inclusive financial market regulation, strong infrastructure, and abundant secondary market liquidity.
Malaysian Government Securities (MGS) are conventional long-term paper issued by the Malaysian government to manage the economy. Government Investment Issue (GII) serves similar function but are issued in the accordance with Islamic principles. MGS floating securities are issued on the basis of a spread. Malaysian Government Securities are debt obligations issued by a sovereign government. They sell this product to fund daily government operation as well as special infrastructure and military projects. This investment functions similarly to corporate debt issues. Corporation issues bonds to raise capital for equipment purchases, expansion and debt repayment. Governments can avoid raising taxes or cutting other areas of spending in the budget by issuing debt each time they need additional funds for a project. Individual and institutional investors will purchase government security after they are issued, either to hold until maturity or to sell to other investors on the secondary bond market. For a variety of reasons, investors buy and sell previously issued bonds in the market. They may want to earn interest from the bonds' periodic coupon payments, or they may want to allocate a portion of their portfolio to conservative risk-free assets. These investments are frequently regarded as risk-free because when the time comes for a redemption of maturity, the government can always print more money to meet demand. Next, a government bond is a debt instrument issued by the country's central bank, which is Bank Negara Malaysia (BNM), and state governments to finance their needs while also regulating the money supply. When the government needs funds for infrastructure development or to finance government spending, such bonds are frequently the solution. As a result, the government will issue bonds to general public, encouraging investment. At the bond's maturity date, the government will repay the principal and interest in accordance with the terms of the bond.
Next, I will explain a few advantages in investing in government bonds. Firstly is low default risk. Investors who purchase government bonds are guaranteed returns and financial security. Second is returns. Bond investments may provide a better return than simply holding cash because government securities may be able to provide a consistent flow of interest income because there is a guarantee of principal along with the fixed interest. Third is liquidity. Government securities are simple to buy and sell because these bonds have the same level of liquidity as banks and other financial institutions. Fourth, it is a portfolio diversification. A portfolio that includes investment in government bonds is well diversified for the investor. And lastly is as regular income. According to RBI regulations, holders of government bonds may receive interest payments every 6 months. As a result, it offers bondholders the opportunity to invest their unused money and receive a regular income.
They are characteristics of instrument government securities. First of all, number one, no credit risk. Credit risk is the chance that the borrower won't be able to pay back the loan plus interest. Government rarely fail to pay their debts on time. If they went into default on their loan, it would be challenging and expensive to borrow money in the future. Even when nations experience severe crises, they would be worked to prevent default. India has never missed a payment on a debt. Second, wide range of product. There are many different types and maturities of government securities. There are GSECs that pay interest that is inflation indexed as well as GSECs that do not. While that GSEC can have maturities up to 40 years, treasury bills which are offered at a discount to face value can have maturity as short as 14 days. GSECs allow for the purchase of gold using sovereign gold bond as well. Number 3 is tradable on the secondary markets. On the secondary market, government security can be bought and sold. Banks and other significant financial organizations were the only one allowed to invest in GSECs until recently. Retail investors can now invest in GSEC as well with the implementation of the Retail Direct Yield Scheme. Next, number 4, subject to price variation due to interest rate change. The interest rate and bond price relationship are inverse. New bonds are issued with interest rate payment following interest rate increase. Older bonds with lower interest rate will lose popularity and see a decline in price. Interest rates on bank saving account and fixed deposit will decrease following interest rate reduction. In addition, lower interest rate will be paid on a new bond. In the long run, older bonds with higher interest rate would become the favourite asset for reliable returns. The cost of old bond rises as a result. Next, coupon payment. Bond interest payment are known as coupon payment. The face value of the government security is used to compute the interest. These payments are calculated using an annual interest rate and are made on a regular basis. Compared to alternative options like fixed deposit, investing in government security over a longer maturity period can be profitable for persons who want to have a predictable income. Bond could provide higher interest rate as well. Lastly, lower return. Any investment involves some level of risk. Investors receive a risk premium as payment for the risk. Government security often don't charge a risk premium because it is presumed there is no risk. The return on GSEC are lower than those on corporate bond or other securities and there is no risk premium.
I will present about the tenure of the instrument. As part of its attempt to build a benchmark yield curve, the Malaysian government has committed to routinely issuing 3, 5, 7 and 10 years MGS as benchmark securities. Benchmark offerings may be renewed in order to increase outstanding issue size and so boost market liquidity. In addition, 15 and 20 years MGS have been issued to prolong the benchmark yield curve. The normal transaction lot size for MGS is 10 million ringgit. Aside from regular MGS, callable MGS have been issued since 2006 to allow the government to repay such bonds prior to their maturity dates. Callable MGS are repaid at par may be called with 5 business days notice to bondholders. This tenure is 31st January 2023, which is the latest trending date. As you can see this table, it shows that tenure for 3 years has maturity until March 2025 and the coupon rate was 3.882%. The training yields for law is 3.34%, for height 3.41% and close 3.39%. The total volume is 379,097,097. For the daily change in term BPS, which mean basis point, for this tenure is 3 BPS, referring to the table, the same as for 5, 7 and 10 years as well.